Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. Work programs are underway in Finland and Canada. Arctic Star trades on the TSX Venture Exchange symbol ADD, on Frankfurt symbol 82A1, and the OTCQB symbol ASDZF. Please visit our website arcticstar.ca or call us at 604-689-1799.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Victor Adair, co-founder of the Polar Futures Group. He's Senior Vice President and Derivatives Portfolio Manager at PI Financial in Vancouver. His website, polarfuturesgroup.com. Welcome back to the show, Victor.
Jim, good to be talking with you. Thank you.
Victor, let's start with the stock market. The S&P, NASDAQ at all-time highs. The Dow Jones is almost nipping at it. The Toronto Index at all-time highs as well. The European markets are soaring. Asian stock markets are also strong. What's going on there, and can this continue?
Well, I guess that's really the $64 zillion question, but what's going on? Obviously, a lot of it has to do with the central banks around the world. The Fed, the central bank in number one position, had that pivot back at the end of last year. We've seen other central banks, including today, the Bank of Canada, changing their tune. So the thought that instead of being in a rising interest rate environment, we're in an environment where more than likely interest rates are going lower has been, say, music to the ears of the stock market. We also got in too much of a hole, I think, back in December. Now, with good reason. I mean, the stock market was down, and then the Fed kicked it, at their December 19th meeting. We took another 1,000 points off the Dow following that. So part of the rebound back that we've had since Christmas, I think, has come from being too deep in a hole there in the first place. But, I mean, make no mistake about it, this has been a very powerful rally off of the lows we had in December. Any number of things, whether it's, thoughts that there's going to be a deal done between America and China on trade. There has been Chinese stimulus in the market, where, maybe a few months ago we thought the Chinese were maybe putting the brakes on things. There has been another record level of corporate share buybacks in the United States. But, if you back away a little bit and look, say, at a 5-year chart, you can see that the market, that is, the major American stock indices, has kind of gone broadly sideways for about a year and a half now. Now, it's been pretty choppy, if you want to take that point of view, but there we go. At the moment, in the very short term here, I mean, we've had this very strong rally. The sentiment that I look at, in other words, let's call it the overbought, oversold kind of indicators, we're at extremes, not only in the United States, but even more particularly in the European markets. Some people have pointed out that we've got, a rally on low volume, so maybe in their eyes, there's sort of less value to it. Personally, I had thought, and there's nothing like it being able to admit that you're wrong, but I had thought that we were having a short covering, or rather, call it a bear market rally as we started in January and February. I shorted the market a couple of times by buying out of the money puts, even got onside those positions a couple of times, but closed them out with a loss. The thing that I didn't do, and this is my risk management trading, was to aggravate the situation by, staying with a position where I was wrong or adding to it. I basically just looked at it and thought, I can't bring myself to buy it, but, I'm sort of smart enough not to short it either. So, I guess, where do we go from here? I mean, I could picture a scenario really where the market just continues to go higher. There is a FOMO drive to it, that fear of missing out, particularly people that are managing other people's money. They gotta buy this market to keep up with the competition or they lose assets under administration. I can picture the market going higher. I can also picture that it actually is a bear market rally and we get a break from here. I am, and as we talk today, I think you'll get this, I am less inclined to try to believe the stories that are circulating about the markets, and more I look at the charts. So I will watch to see if the market wants to turn over and go down, then I'll get short, but I'm certainly not going to try to pick the top to this very powerful rally.
In other words, surf the waves and don't worry about what's causing them?
Yeah, that sounds almost adolescent, doesn't it? Like that's kind of dumb to do that the really smart guys burrow out the facts and all that sort of thing. I am old enough to admit that I know barely enough, to kind of keep my nose above water. And that's one of the reasons that I look at the chart. The thing that I'm trading is price. And, why it is where it is, it's tempting to want to work that out. But yes, surf the wave, and certainly, don't try to sell short a market that's going up.
Volatility is very low. Is that because markets have been rising steadily, or is there more to it than that?
Yeah, that's a great question. It's a bit of a puzzle. We've got, say, currency market volatility. What's volatility? That's like, what's the degree of chop in the market? What's the degree of, market scared to death that, a move is going to get extended? For instance, with the stock market, we were trading at, let's call it the better part of multi-year lows last October. When the market fell into the lows at Christmas time, volatility more than doubled. Mm-hmm. Now, as the rally has happened since Christmas, volatility has gone back to the levels where we were at in October. Volatility in the currency markets, 5-year lows. In some respects, the low volatility it represents, say, a complacency on the people that are trading. I think there's been distortions, particularly in the past few years, on vol because a lot of people love to sell volatility. It's like another way of reaching for yield, and that changes things. But what I do know, if you look, again, at a long enough chart, you go back, say, the past 2 decades in the currency markets in particular, when you have periods of really low volatility, they're almost always, it kind of stands to reason, followed by periods of time when you get a big move in the market. So I'm really focused on the U.S. dollar now, much more so than the stock market. I think the U.S. dollar is kind of a big story, so I'm really paying attention to that low vol environment in the currency market.
We'll have more with Victor Adair when we return.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain Royalty Corp. is a Canadian-based mineral exploration project generator. The company currently holds multiple property interests in Ontario with joint venture partners and is seeking further joint venture partners for other drill-ready properties in our portfolio. For more information, please visit our website at rmroyalty.com or call me at 604-922-2030.
Welcome back. We're speaking with Victor Adair. Victor, you've been bullish on the U.S. dollar for quite some time. Is that still the case?
Well, I think, Jim, to be fair, in almost in every interview that you and I have done this past year, I've been bullish the U.S. dollar. I've been bullish the U.S. dollar for a few years now. And I'm still bullish, and if anything, I'm even more bullish right now. I mean, just today, we've had the U.S. dollar break through the highs that it's made here the past 4 or 5 months, and we're trading at a fresh 2-year high. I am long of the U.S. dollar, and when a move like this comes along, the first thought is, gosh, as a friend reminded me this morning, you never have enough on when you're right. So, yes, I remain bullish the U.S. dollar. It's been trending higher for 8 years or so. That I know there was a low back in 2008, but I kind of take the start of the rally in the U.S. dollar as 2011, 2012. That was at a time, for instance, when gold was making its all-time highs above $1,900. there's been this lid on the U.S. dollar the past couple of months at 98 cents on the dollar index. We've ripped up through that today. I have traded currency markets for 40 years, and one of the things that stays in my mind is that trends in the currency markets just go way further than you think makes any sense, and then they'll turn on a dime. But if you want to see markets that can have momentum, I'm telling you, currency markets are very much that way. This breakout here, you're always afraid, right, to buy a breakout. Gosh, what if it sets back? Then you're the idiot that paid the high price for something. But I would not try to fade the U.S. dollar here. This looks like it could get stronger. There's a number of stories that would support why the U.S. dollar could do better. But again, as I said earlier, I'm looking at the charts more and more these days as I've gotten older and just try to sort out the confusion. So, yes, I'm still bullish the U.S. dollar. Do not be short the U.S. dollar.
The Canadian dollar's been fading. Is that just the flip side of a strong U.S. dollar?
Jim, that's very much the case. There's an interesting thing with the Canadian dollar, I'd say, the past couple of months. And it has, if anything, drifted sideways. I mean, we had a pop-up right the first couple of days of January after it had been hammered into a hole in December. But the interesting thing is it's really had no lift from the rally in crude oil. I mean, we've seen the price of WTI go up about 50%. The price of Western Canada Select has tripled from the lows. There has been, and I'm emphasizing this, it's what they would call a negative divergence, when something happens and nothing else happens. So you got this strong bull market in crude oil has no doesn't help out the Canadian dollar at all. Another negative divergence, I think, is I've seen in times prior where Canada would be bid higher as the U.S. stock market goes up. That didn't happen this time either. As we've talked on this show many times before, the Canadian dollar, the main things, in my view, that move it are the relative strength of the U.S. dollar against all currencies, the commodity market, especially oil, and interest rate differentials between Canada and the United States. For the past several months, the interest rate differential has definitely favored the U.S. dollar. That continues to be the case. But I think the key thing, and you just nailed it, it's the U.S. dollar strength that has been making the difference, been driving the Canadian dollar down. It was just a few years ago, 2011, I mentioned that start date for the bull market in the U.S. dollar. The Canadian was at par. Now 75 cents seems to be too high. And then today, the Bank of Canada came out and, really backpedaled from any thoughts that they're going to be tighter or raising interest rates, that sort of thing. So I'm short Canada. I wish I was more short. I think Canada is, it's any rally in Canada from a trading point of view, I'd look to sell it.
How's the Canadian currency doing compared to other currencies? We always compare ourselves to the U.S., but
Sure.
What about other currencies?
Good question. Canada, for instance, has been doing better against the other major commodity currencies, the Australian dollar and the New Zealand dollar. I think a bit of that is Canada is next door, does a lot of business with, the United States, Australia and New Zealand, next door to China in a way. So the United States economy, which still seems to be, turning over reasonably well, certainly compared to the whole Eurozone bloc, you say Canada's in a better neighborhood, in that sense. So Canada's, relative to some other currencies, is doing pretty good. But as you say, we measure it against the U.S. dollar, and that's mostly what matters.
Sure, because, I look at the British pound. When I visited in 1979, it was about $1.75, and it's about $1.75 today.
Sure. I mean, there's people that are really trading currencies are going to do things like trade, say, the Japanese yen against the Canadian dollar. Going to trade the euro against the Swiss franc. We talked about that on the show before. But, for the purposes of what we're doing here today and what I'm prepared for, I haven't got my notes in front of me about, Canada euro. Canada has been weakening for the past several years against the U.S. dollar. I think that trend continues.
We'll have more with Victor Adair right after this.
Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. Work programs are underway in Finland and Canada. Arctic Star trades on the TSX Venture Exchange symbol ADD, on Frankfurt symbol 82A1, and the OTCQB symbol ASDZF. Please visit our website arcticstar.ca or call us at 604-689-1799.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're chatting with Victor Adair. Victor, gold is down over $80 since its February high. You told us many times gold struggles in a strong U.S. dollar environment. Is that why gold has gone down?
Again, Jim, short answer, yes. The U.S. dollar, when you've got a strong U.S. dollar, that's a serious headwind for gold. One of the other factors on gold is the relative level of real interest rates, and actually the past couple of months, that's been kind of favorable for gold because real interest rates have been easing as nominal rates have fallen off. But, the rising stock market, for instance, is kind of a problem for gold. Like, I'm saying this in a sarcastic way, that who needs gold when the stock market's going up? I mean, you buy any stock you want, and you're going to make more money than if you bought gold. Last summer, for the first time in 10 years, the speculative position on the New York COMEX exchange was net short of gold. There's just been, it's been ignored in a way. There's other things to do. And when the U.S. dollar is strong, that's tough on gold. Now, you could get to a point, and we've seen times in the past when the U.S. dollar and gold are both rising at the same time. I'd say that would be in an environment where markets a little fearful, or, it's risk off, to use that term, where you want to go to the safety of the U.S. dollar or the safety of gold. But no, from a technical point of view, we've had this $80 fall from the highs we had in February. That brings us down to the 50% retracement level of the rally we had from last November up to the highs in February. So we might get a bit of a bounce here. The major technical setup that I've been talking about for the past 2 months, I guess, on gold is this big head and shoulders top that's been developing from January through April. We've broken the neckline on that head and shoulders pattern. The target on that alone would be about $1,225. So, we'd have more to go on the downside. I am short gold, like I am short of the Canadian dollar, and I've been short for a couple of weeks. And at the moment, I'm staying short.
Crude has surged about 50% since its Christmas low. Do you think we could get back to the highs made last October?
Boy, actually, no, I don't in the short term. But again, just like the stock market, the rally, the strength of the rally we've seen in crude oil from the December lows has amazed me. We've talked here a couple of times. I've thought that the market was so focused on supply or the shortage of supply that they weren't paying any mind to, is there enough demand out there? It appears as though OPEC and friends, as I call them, have actually reduced the amount of oil that they're putting onto the market. Now, in some cases, like Venezuela or Iran, they weren't doing it voluntarily. It was being done by outside circumstances. And speaking of Iran, I mean, we know here in a week or a little better that the additional waivers that the Americans had granted to a number of the countries, Korea, Japan, China, Turkey, Greece come to mind, that have been importing some crude from Iran. The States wants them to stop altogether, like put Iranian exports right down to zero. So there's been these stories as to why crude oil price keeps going up. the fact is, it's had a heck of a rally. We're up 50-odd% from the lows, as you just mentioned. I think kind of like the stock market, I kind of think, gee whiz, maybe it'll set back, but I think we're up for 8 consecutive weeks on crude. It really feels like it's, cruising for a bruising. But I am not short, and I won't get short unless, the market actually breaks, and then I'll look to sell it that way. But it's been an amazing rally. It's definitely gone further than I thought. Now, can we get back to the highs at $75? Absolutely. But how far out in the future do we go? I think that we are going to see higher crude prices in our future. Whether that's maybe later this year or into next year, I think would be more likely the time frame for getting back to $75.
Now, we hear that Iran is getting around the U.S. sanctions by shipping its oil through Russia. Do you think when they say there's sanctions that they mean much anymore?
The sanctions definitely, reduce the exports out of Iran. Will they get reduced to zero? Not likely. I mean, I don't think the Americans the administration anyway, in their wildest dreams think that they can actually plug every last barrel of oil coming out of Iran. But that's not the objective. It's just to dramatically curtail it. I think we were talking, maybe it was last year, the Iranian currency has just gone to pieces. They've got real economic problems over there. So if, in effect, the Americans can strangle them economically, maybe they'll get a change of government there or something, whatever it is the administration is hoping to achieve, sort of bring them to heel. But no, they're not going to block all the oil. There'll be some oil will get out of the country for sure.
Interest rates have been falling since the Fed surprised everybody in December. That's good news for people with mortgages. But what about interest rates in the future? Do you think they're still going to go up?
Again, that's what's the future? Right at the moment, I am long of United States Treasury bonds, the 10-year bonds. I think, I guess maybe the background on that is I believe we've got a global economic slowdown, particularly in Europe, and that risks spreading to other parts of the world. We've had an economic expansion driven by central bank easy money for the past decade. And I think in a way being long the bonds is an easier way to play a possible break in the stock market. Trying to be short stocks is that's you can get hit there pretty easy. The U.S. Treasury market is trading at a huge yield premium over a number of other sovereign issuers around the world. I mean, German 10-year bonds are yielding zero, if not less than zero, and you're getting huge premium there in the United States. At some point, I kind of understand, the story that says there's so much debt in the world at some point, people will run away from lending money to others unless they get paid a huge premium. But maybe turn it around a little bit. There's different kinds of interest rates. I think we've seen with the stock market rally off the Christmas lows, the yields on junk bonds have really fallen. So there's been a terrific rally in their price. If the world does get fearful of economic growth, you could see junk bonds get sold off while U.S. Treasuries get bid. So interest rates aren't monolithic. At the moment, I'm long the 10-year Treasury bonds, so that kind of tells you what I think, or how I'm positioning anyway, in terms of where I think interest rates are going in the next month or two.
Victor, you've been in this business for 45 years. Do you trade any differently now than you did in years gone by?
Yes, I think so. Let's see. Maybe the first thing that I'm different now, and I'm 69 years old now. When I was 29, I used way more leverage than I do now. I hardly ever use leverage with the markets I trade now, so I'm maybe more cautious that way. I think, or another, as in trading, we talk about it as sizing. Now, I just got through saying, when you're right in the market, you can never have enough on, but, it's nice to be right. It's how you prepare for being wrong that's important. I think I use charts more now than I ever did. And something I'll say to my son is there's people that are trading in the markets that we're trading that you just can't imagine who they are or particularly what's motivating them. You just have no idea. I used to think that if you studied enough, read enough research, you could understand something. And, you understand something, but you may just be reinforcing a bias that you already have. I used to say to people, are you bullish gold because you own gold? Or do you own gold because you're bullish? And it's a tricky question. So I look at the chart. The only thing I'm trading is price. So, regardless of what it is, or you mentioned earlier, you surf the wave. If the market's trending higher, then you should think in terms of being a buyer. Now, if you absolutely hate it, you can't bring yourself to buy it. But, I use charts more than I used to, just because I now know I hardly know anything. When I was younger, I probably thought I knew something because I had some opinions. And maybe one last thing, and that is to say, picking a trade is easy relative to staying with a trade. So I think I'm more patient with a trade now than I used to be. That is, patient with a winner. I'm still really quick to kick out a trade if it's not working. I think that over the years, if I saw one common denominator in clients that I had or the brokers that worked for me had, the one common denominator of people who consistently don't make money in the market is people who hang on to losing trades. You got to get rid of them. You're going to be wrong. It's not a big deal. Just sell it and, put your money into something that's working rather than trying to, talk yourself into giving something that's a dog one more day.
Victor, thank you so much for chatting with us.
Jim, it's always a pleasure. Look forward to talking to you again sometime soon.
Our guest has been Victor Adair, co-founder of the Polar Futures Group. He's Senior Vice President and Derivatives Portfolio Manager at PI Financial in Vancouver. His website, polarfuturesgroup.com. If you have any questions for Victor or any of our other guests, you can send them to info@howstreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.